For the rest of this course, we're going to focus on the indirect method, which, as I've already mentioned, is by far the most common approach used by organizations. There are three main sections on the cash flow statement. The first section focuses on a business's operating cash flows. Operating cash flows and transactions are those that relate directly to the generation of revenue, whether that be revenue or expenses. And basically, they're the reason the company is in business. Investing transactions and cash flows include decisions around things like the purchase of property, plant, and equipment to really support the business and its operations. So, for example, manufacturing companies will need to buy factories and equipment to manufacture inventory for sale. Services businesses may need to buy buildings and furniture to support their operations. Finally, we have financing transactions, which are based on management's decisions around how best to fund its business activities. A business typically has two standard sources of funding: raising equity from shareholders by issuing shares, or raising debt finance by borrowing from financial institutions like banks and credit unions. These cash flows are all captured in this section of the cash flow statement. Now let's work through each of the three sections in a lot more detail. We'll start with cash from operations. Recall that the operating cash flow section starts with net income, and then what we do is we make adjustments for non-cash items like depreciation and changes in working capital. Remember changes like accounts receivable, inventory, and accounts payable. One of the trickiest parts from my experience as it relates to the operating section of the cash flow statement is really understanding how changes in working capital, that's things like accounts receivable, inventory, accounts payable, and unearned revenue, impact cash flow. So for this reason, I want to walk you through this in some detail. Now, when we're dealing with transactions that have an indirect impact, we need to look at what has changed, and then what we have to do is determine if that indicates an increase in cash flows or a decrease in cash flows. Let's look at accounts receivable, inventories, accounts payable, and unearned revenue individually. So we're going to start with accounts receivable. In year one, this company had $46,000 in accounts receivable. In year two, the accounts receivable increased to $51,000. As the result, the company has $5,000 less cash. In contrast, if we saw accounts receivable go down, the business would have received more cash. So, in summary, when you see accounts receivable goes up, cash is going down, and we're going to express that as a negative number. Conversely, when accounts receivable goes down, cash is going up, and so we're going to express that as a positive number. For inventory, we're really looking at how much have we sold. When we sell inventory, we obviously bring in cash. Now, if our inventory goes up, we consider a business to have received less cash because inventory is piling up. In this case, inventory decreased from $82,250 to $78,050, which indicates a net increase in cash of $4,200. Now, inventory is very similar to accounts receivable. They're both current assets. So when inventory goes up, cash is going down. So we're going to express that as a negative number. And when inventory goes down, cash goes up. And we represent that with a positive number. We're now going to move from assets to liabilities. Now, liabilities work in the exact opposite way to what we saw with assets. So, for example, if accounts payable goes up, the company has used less cash to make their vendor or supplier payments. On the one hand, it's good that the company is paying down its liabilities. However, this results in less cash on hand. So just remember that liabilities work the opposite way to assets. So when accounts payable goes up, cash goes up, and we're going to show that as a positive number. But when accounts payable goes down, cash goes down, and that's represented with a negative number. With unearned revenue, it's going to work very similarly to accounts payable. Remember that unearned revenue, sometimes called deferred revenue, is recorded when a company receives cash in advance of providing the service or selling the good. As a liability, it works the same as we saw for accounts payable. So if unearned revenue decreases, as is the case here, it indicates less cash received in advance and is therefore shown as a net cash decrease of 2,900. So in summary, when unearned revenue goes up, cash goes up, and we show that with a positive number. Positive numbers are used for cash inflows. When unearned revenue goes down, cash goes down, and we show that as a negative number representing a cash outflow. Let's build out an indirect cash flow statement, starting by focusing on operating cash flows. Now, what we're using is the Cobble Hill year 1 and year 2 exercise we did earlier, and we're just building on that. But right now, we're just going to focus on the first section, and I'll just zoom in a bit. And that's our operating cash flow. So we're going to start with net income. We're going to add back depreciation, which we're going to find on the income statement. Then we're going to have to look at changes in accounts receivable, inventory, and accounts payable to get us a cash from operations. Okay, so let's get going. So the cash flow is at the top. I'm going to start linking this, and I'm going to go down now. I need to go to the income statement right at the bottom. I need to go to net income. We're going to start with 8. Then what we're going to do is we're going to add back depreciation. So I'm going to put a negative sign here because then what I'm going to do is I'm going to find that depreciation number, which we know is 90. And I need to make sure it's a positive because remember we add back non-cash expenses, and that's depreciation. Now we have to think about what's happening with accounts receivable, inventory, and accounts payable. First of all, remember that inventory and accounts receivable are both assets. So we're going to treat them in a very similar way. Accounts payable, we're going to treat in the reverse way. So let's go to the balance sheet and just look at the differences between accounts receivable, inventory, and payables between years 1 and 2. Now, what we have in year 1 is there was 80 of accounts receivable, but that 80 has now increased to 150. So that's more cash tied up with customers. So you want to think of that as a cash outflow. Here we have inventory of 60. Inventory's increased to 80. So we have more cash tied up in inventory. So that's also going to be a negative number. The way I like to do it is just make sure that I am taking always the previous year and I subtract the current year for assets to make sure the sign is the right way around. I'm just going to copy that down. So we know it's minus 70 for accounts receivable and minus 20 for our inventory. So I'm going to just now capture that. Minus 70 and minus 20. Good. I'm just checking that I got the right numbers there. Now we need to go to accounts payable. Now, when we look at our accounts payable, you're going to see that it's increased. Now, the good news here from a cash perspective is that that's cash that we owe that we still haven't paid. So that's cash that is still with us. So the way we make sure we have the right sign is always take the current year minus the previous year. It needs to be a positive number if accounts payable has gone up. So we know that's a positive 20. I'm going to capture positive 20. And then I'm just using alt equals to sum that up. And congratulations, we've done the first section of an indirect cash flow statement focusing on operating cash flows. We are now going to turn to the second section of a cash flow statement, and that's cash from investing. The good news is cash from investing generally is a bit easier to understand. In this case, the company purchased $45,000 of equipment in their first year of operations. As a result, cash decreased by $45,500 in that year. In the next year, they invested an additional $50,000 of equipment to expand their operations. And if we look at the fourth year, they invested another $59,500. In each of these cases, this investment is considered a cash outflow and is represented by a negative number. These investments are often referred to as capital expenditure or capex for short. Before moving on to the next section of the cash flow, it's interesting to see how the financial story of non current assets are reflected on each of the statements. In particular, how investing activities like capex ultimately hit all three financial statements. We just saw transactions related to the purchase of property, plant, and equipment, or capex. But recall that once we have those assets, they're put on the balance sheet, and then we depreciate those assets over their useful lives. So we have a cash flow impact from buying the property, plant, and equipment, a balance sheet impact in terms of property, plant, and equipment as a non current asset. And on the income statement, we're going to see an expense related to depreciation. Let's look at a tangible example of how this works in practice. Let's imagine that a company has an equipment purchase in year one for, let's say, a company car, and they're going to use straight line depreciation. So, first of all, we need to calculate the depreciation expense. We know the car was purchased for $45,500. We're going to assume a useful life of 10 years, and we're going to say at the end of 10 years that the car will have no salvage value. So, using our straight line depreciation approach, we can calculate that the depreciation on this asset, the car, will be $4,550 a year. Let's see how all of this impacts each of the financial statements. On the income statement, the depreciation expense is either going to be shown separately as a separate line item called depreciation expense or depreciation and amortization expense. Sometimes, though, that depreciation expense is combined with other operating expenses. So we might find that depreciation in direct or indirect operating expenses. So that's the income statement. Now let's look at what's happening on the balance sheet. On the balance sheet, we're going to first see the purchase or the capex first recorded as the cost of the asset under property, plant, and equipment, or PP&E. That will be $45,500, but we will also record accumulated depreciation as a contra asset account also on the balance sheet. So the equipment then has a net book value at the end of year one of $40,950, taking off 1 year's depreciation. Finally, let's look at how capex hits the cash flow. We've seen that capex hits the cash flow directly under investing activities, but it also impacts the cash flow statement indirectly through the operating cash flow section. Recall that we need to add back non-cash expenses, and one of the largest or most common is depreciation. So under the operating cash flow section, we're going to add back depreciation related to the investment in capex, but we're also in the investing section going to show the cash outflow when we purchase the asset. Now let's focus on the investing cash flow activities. Typically, the primary cash flow activity here is buying property, plant, and equipment. So now let's work through it. Now, what we have is we just have that one line item, but we often need to try to back out what the capital expenditure actually was. And I can show you how to do that. So if we scroll down and we find row number 34 through 37, what we have here is I've started filling it in. I'm just going to delete that. And what we're going to do is we're going to back out capex. And what I mean by that is we can solve for capex or capital expenditure because we'll know what the opening balance is, the closing balance, and we know what depreciation is. And the number that makes it all balance has to be capex. So what I'm going to do is the opening balance for year two is the closing balance for year one. We also know that the PP&E at the end of the year is going to be on the balance sheet. It's $720. We also know that the depreciation expense is $90, but I'm just going to link it to the income statement. And now all we need to do is we can solve for capex because that's going to be the difference. And the way we do that, I'm just going to go equals, it's the closing balance minus the depreciation or add back the depreciation minus the opening balance. And so what this tells us is there was no new spend on property, plant, and equipment in the year. But I always like to check to make sure it's working. So I'm going to kind of destroy the balance sheet just for a second, and then we'll restore it. What I want to do is I'll say, okay, well, that's because there's 810, there's 720. We know that depreciation was 90, which is why we know capex. There was no capex. Now, if we said that that property, plant, and equipment at the end of the year was 800, now remember the balance sheet's not going to balance because I've just overtyped it. What that means is we have to think about what would that mean for capex. And if we go to our formula, you can see now a number in capex. What we're saying is that there had to be 80 spent on new property, plant, and equipment for this equation to hold. So let me just do Control Z or Control Z to undo that. Because congratulations, now all we need to do is we need to link that number into our capex. But one of the things I'm going to flag is it's a cash outflow. And so we need to make sure it's always the right way around. So I'm going to put a negative sign there. And again, I'm going to show you why we need to do that. Let me overtype the 720 again with 800. So we know our capex is 80, but it's a cash outflow. So we need to make sure there's a negative sign there. So let me type that back to 720. And we are good. And then the total, there's only one item here. We are done the investing cash flow section of our indirect cash flow.